Okay, Steve, ready? I'm going to go.
Great.
Okay. So I want to welcome you to Nisivoccia Presents, and it's a webinar series designed to provide educational and informative content to our clients and our friends. And this is our second segment. Today we have the pleasure of welcoming Steve Galli, and Steve is the Chief Investment Strategist for Nisivoccia Wealth Advisors. Steve has over 25 years of financial services experience, focusing on investment strategy, asset allocation, and wealth management. So for those of you who may not be aware, Nisivoccia Wealth Advisors is a separate wealth management entity with a team of financial advisors who work with our CPAs to provide our clients a tax-centric approach to investing and planning. You can learn more about Nisivoccia Wealth Advisors by visiting their website at nisivocciawealth.com. And Katie will also put the link in the chat box, and you can access it through there as well. So we'd like to make today's session as interactive as possible. So please use the chat box, the Q&A, or raise hand feature to ask any questions or to provide any comments. And I'm going to now turn it over to Steve. And then when he's finished, we'll also have Q&A at the end. And then before you exit, a survey will pop up for you to rate today's session. And we ask that you please take just a minute and fill it out for us. And there you go, Steve.
Thank you, Laura. And thank you all for joining today. I hope you find this informative and helpful. And certainly, please let us know if you do, because we need that feedback so we can make these better as we continue the series. Again, thanks for joining today. So we have a lot of different things to cover. And as Laura mentioned, you can ask a question during the presentation. That's okay. We'll try and take some moments to pause and answer questions that come in as we're talking. And if you want to be comfortable and just wait until the end to ask a question, that's fine as well. So with that, I'll just get right into it. So we're going to talk about some of the big headlines that many of you may have seen regarding the financial markets that have been, both incredible and interesting all at the same time, including, record high U.S. stock market levels, record low interest rate levels, record high government spending levels, SPACs, and cryptocurrencies, all of which have been making major headlines recently. So just to warm everyone up, let's start with a question. Since the low point in March 2020 of last year, what has been the return of the S&P 500 index since the March 2020 low? You've got 4 options up there on the screen for the poll, so feel free to take a quick guess. We will tabulate it fairly quickly and then reveal the answer.
Just give it another second.
Katie, let me know when you think we have a critical mass of answers.
All right. Everyone got their votes in. A couple more seconds. All right. Mostly everyone's in. I'll go ahead and share. Can everyone see?
So we have about half of you, half of the respondents saying 49%. Good guess, but no. Staggeringly, since the low point of last year, the market, as defined by the S&P 500, has actually returned 85%. And that's just really a staggering return in such a short period of time, basically in a little over a year. I mean, a lot of people, in general, you should be happy with that type of return after 7 or 8 years, let alone, 1 year. So we're going to talk about that. What's been driving that? Is that trouble? Is that a sign of trouble or excess? So I always like to take a look at, this is actually a chart of the S&P 500 over the last 25 years. So let's call that modern history, right? So as you can see, it shows both the uptick and the downdraft after some major market events. So the first event you'll see on March 24th of 2000, that's when the market reached its high before the dot-com bubble burst, right? And that was that led to a 50% or basically a 49% decline in the S&P 500 when the dot-com bubble burst. Similarly, in 2007, we had the financial crisis, right? When the mortgage market meltdown, among other things, we had a 57% decline after that market crisis. The long march upward in the market, basically 400%, until we got to last year and the pandemic hit. And when the pandemic hit, we had a 34% decline in the market, one of the fastest declines in history in such a short period of time, followed by one of the fastest rises in history, or the fastest rise in history, which is that 85% return since the low on March 23rd to where we stand today. And this, this is as of a couple of days ago. So, so a lot of the questions we get is, wow, is the market getting way ahead of itself? And, the answer is probably, yeah, a bit. So if we look at the PE ratios over the last 25 years, so one of the comforting factors here is that the PE ratio at the height of the dot-com bubble was over 25. And what's a PE ratio? PE ratio is the price to earnings ratio, meaning how much are you paying for a company based upon how much earnings that company is expected to give you, right? And so the historical rate of the PE ratio over the last 25 years or so is around 16 or 17. So certainly we are well above that average now at about 22. But it's not as high as it was during the dot-com bubble when it was approaching 25. But there is a major difference. During the dot-com bubble, the 10-year Treasury bond, or a common benchmark interest rate, was over 6%, meaning if I loaned the US government money, they would pay me a 6% interest rate on that loan for 10 years, which, today that sounds pretty good, because now if I do the same thing and loan the US government money, they're going to pay me 1.6%. So if I give them $1,000, I'm not really going to get much of a return. I'll be happy with my $16 return on that $1,000 after an entire year. Not that great. So that's one of the reasons why the market is at levels that we haven't seen in quite some time. And that's because there's a phrase that you might have heard called TINA, T-I-N-A, which is short for there is no alternative. In other words, if I can't really get a return from bonds, and certainly sitting in the bank isn't going to do me much good because cash returns basically zero, then I really don't have much of an alternative but to be in stocks, right? Which is one of the reasons we've seen stocks have such a meteoric rise. But I would be remiss if I didn't talk about really the pandemic and what has happened both to the economy and market. So this is a pretty interesting chart showing, cases from, the market low of March of 20 till today. So, obviously the market is very excited about the fact that we have seen a dramatic decline in cases as well as a dramatic decline in fatalities. And recent statistics that we've seen are showing that about 80% or over 80% of adults in this country now, greater than the age of 65, have had at least one vaccine dose, right? So that's a pretty encouraging number. And so the gray bar here in the zone for herd immunity, this is where we really want to get to as a country, meaning we feel like we have a critical mass of people who've either had the virus or are vaccinated against the virus, such that the chances of spreading and contracting the virus are much, much lower. And you can see the progress toward that zone over the last several months. And essentially what people are generally predicting when you talk to various economists, as well as some of the statistics from the CDC, we should reach herd immunity in this country by June of this year. In other words, people are saying we should probably have about, be upwards of about 80% in this zone by June of this year, so early summer. And obviously the market is looking forward to that because that means things can get back more to normal and companies can continue to produce excellent earnings results, which we've already seen start to happen. All right, so let's throw another question out there. When was the last time, in other words, what year was the last time the US economy's gross domestic product growth was over 7%? When was our US GDP growth rate over 7% last? Again, you have 4 options, so at least you have a 25% chance of getting it right. All right, let's get those results in.
Got a few more in, then I'll share. Give it another second. All right, I'm gonna go ahead and end it. Everyone get in your votes?
All right, let's see what we got.
Okay.
I see that the majority of you have selected 1984, and congratulations, that is correct. That is we definitely have some economists in the audience. So 1984. Now I love the 80s. I graduated from high school in the 80s. So I have a great affinity for the 80s. So we'll talk about the 80s a little bit here. The 80s is when we last saw, the Karate Kid came out in 1984. If you remember that kind of the movie, which I've definitely seen more than once, with Daniel LaRusso against Johnny Lawrence. What also in the 80s, in 84, some people consider that to be almost the height of the Cold War between us and Russia. So are we seeing eerie similarities to today, right? Because now we have Cobra Kai, a wildly successful reboot of the Karate Kid franchise on Netflix. Again, Daniel LaRusso against Johnny Lawrence. And we are going up against another very large Eastern power, although this time it's China. And this year will likely be the year that our GDP growth on a year-over-year basis exceeds 7%. So the first time in many, many decades. And why are we talking about that? Well, we're talking about that because that means if our economy is really humming along like that, it means the companies in our economy are also going to be humming along and making a lot of money. And at the end of the day, a lot of what drives the market prices are the earnings of the companies in the market, right? So if we have that type of GDP growth, that's very encouraging for the market. And as a matter of fact, that's likely what the market is already anticipating. So, when we talk about you might have heard in the news, like we've had a V-shaped recovery, right? Well, what does a V-shaped recovery look like? It looks exactly like this, right? This is basically the real GDP growth trend in our country on a quarter-by-quarter basis. And it shows what happened to our gross domestic product as a result of the pandemic. It dropped like a stone, one of the most rapid drops in a long time. But we've also snapped back pretty quickly, right? So, and that's one of the reasons why this year we're probably going to see an excellent comparison year versus prior years, and we're really seeing growth pick up. Company earnings, as a result, in 2021, the estimate for company earnings in 2021 are actually expected to be the highest ever recorded. So more than 2019, and obviously more than 2020, because 2020 is when the pandemic hit. And also the expectations for 2022 are that companies in the S&P 500, to be exact, will post record earnings. So the market is definitely looking forward to robust earnings growth in the next couple of years. Now, one of the other things that's really helping this growth is the Federal Reserve. So there's an old saying in the market, which is don't fight the Fed. So what does that mean? Meaning when the Fed is doing everything in its power to stimulate the economy, you don't want to be fighting that trend. You want to be going with it. And that's exactly what's happening now, meaning the Fed has its foot on the gas. It is trying its best to make sure that our economy is humming along. And they're doing that by keeping interest rates basically at zero. So what does that mean? It means money is flying all over the place because it's almost free, right? You can borrow at basically 0%. So that tends to be very stimulative for the economy. That means the Fed is dovish, meaning they want the economy to show more progress. They are not afraid of inflation. They've actually stated that almost outright, that they're really not concerned about inflation picking up. We'll talk more about that. So the don't fight the Fed theory is in full force right now. Now that's going to have some consequences down the road. So you can see, this shows kind of a quick snapshot of our finances. There's a lot going on this slide, but really the interesting thing that if you look at here is that if you look at the sources of our financing, all our debt, right now we're spending, almost $7 trillion. So 50% of the financing of that debt is the 50% of that is borrowing, right? That's how much we have to pay to finance what we're spending. So what ultimately can be the consequence of that? Well, for one, higher taxes, right? And we've heard talk about that happening already with the Biden administration. So that can be a headwind for growth as well as stock returns. And we'll talk a little bit more about that. But this is definitely something to be concerned about because, we can't always just spend money like it grows on trees without actually paying the piper somewhere down the road. Now, I'll also take a pause there and mention there's a new school of thought by some economists out there called MMT. And what does that mean? Well, MMT is an acronym for modern monetary theory. And in a nutshell, what MMT means or represents is, you know what? We should just spend as much as we want for as long as we want because the real arbiter of whether we're spending too much is the inflation rate. So as long as the inflation rate is not accelerating or growing too high too fast, then we should be very comfortable with the fact that we're borrowing like crazy and spending like crazy. That is generally the theory behind modern monetary theory, saying that inflation will tell us if we're spending or borrowing too much. Now, I'm not necessarily a proponent or an adherent to that theory, but that is one thing that's being batted around, which some economists are saying that's why we don't have to worry too much about our large deficits. So let's get back to the market, right? Let's look at how do we see if the market is considered really expensive? We get a lot of questions about this. I think it's a great question to ask. So what this shows is, this actually is a chart of the forward PE ratio of the S&P 500 index, meaning, the price to earnings ratio based upon next year's expected earnings, right? So as you can see here, the 25-year average of the PE ratio, and I mentioned that before, is about 16 to 17, right? 16.66 to be exact. The dotted lines here represent the one standard deviation around that average. So what does that mean? It basically means that 68% of the time, the PE ratio should be within this range, right? So in other words, 68% of the time over the last 25 years or so, the PE ratio has basically been between 20 and 13, right? Are we in that range now? No, we're at 22.3. Now again, is that as bad as it was during the dot-com era? No, but it's getting close, right? So some people say, all right, well, we don't think the PE ratio is a great valuation measure. Let's look at the Shiller PE ratio, or what's known as the CAPE, or the cyclically adjusted PE ratio. What is that? That's looking at the PE ratio over like a 10-year rolling time period. It tries to smooth out the PE ratio by using a much longer period to calculate it. And the average on that is 27 over the last 25 years. And we're actually at 37 based upon the CAPE today. So even if we look at the CAPE or the cyclically adjusted PE, we are definitely higher than average. Well, how about the dividend yield? Well, the 25-year average of this, in other words, what's the dividend yield? The dividend yield is the average yield that a stock in the S&P 500 pays. So on average, the average stock in the S&P 500 over the last 25 years paid about a 2% dividend, meaning that even if the S&P index did nothing for a year, you would at least, in terms of return, at least you would get a 2% dividend for being in those stocks. Now, that's a lot lower. Now it's actually below 1.5. That can be also a sign of excess. So the market is overvalued based upon that measure. Any measure you want to look at, price to book, price to cash flow, again, 25-year average, and the latest, a lot higher than the 25-year average. The only comfort that we can take really based upon valuation measures is this interesting measure here, which I kind of like. This is called the earnings yield spread. What is that? Well, the earnings yield spread is essentially what you can get from an investment grade bond. And what's an investment grade bond? An investment grade bond is a bond that is not junk or really dangerous, right? It's considered reasonably safe by the major credit rating agencies. I actually used to work for a credit rating agency, and we can talk more about that if you'd like, but they're fairly reliable in gauging the risk of fixed income securities. So this earnings yield spread is showing that the 25-year average for this earnings yield spread is about 0 or 0.08%. And now it's at 0.87. So that is the only measure that is actually lower than historical averages. And that is actually one of the reasons why the market is where it is because it is very difficult for investors to get a reasonable return from fixed income securities. So let's dive into that number for a second, because then a lot of people ask, well, how much do interest rates have to rise for people to then say, okay, well, now I'm going to invest more in bonds and not maybe invest in stocks? And I think that's a great question to ask. So let's dive into that earnings yield number for a second. How do you arrive at that number? Well, first, we have to know what the earnings of the S&P will be, what the expected earnings of the S&P will be over the next year. And so we'll use the Goldman Sachs forecast. Thanks, Goldman, for this. They're basically saying in 2021, their estimate for earnings per share of the entire S&P 500 is $181. Okay? Thanks. We'll use that number. That's probably a good number. What's the S&P index at? This is as of yesterday's close, so we'll call it 4135. What is the investment grade corporate bond yield that we should use for the calculation? Well, right now, if you invest in your average triple B plus corporate bond yield or BAA corporate bond yield, you're going to get about a 3.6% return, okay? So we take that $181 earnings from the S&P, divide it by the index level, which is 4135, and we convert that to a percentage, and that gives us 4.37%. Then we subtract what we can get for an investment grade bond, 3.8, and that gives us the earnings yield spread, which was that number we saw up here. This says 0.78. We're pretty close, 0.79. So what does that mean? Well, that means to get back to that average rate where 0.08%, yields would have to rise by 71 basis points. What's a basis point? A basis point is 1/100th of 1%. So basically 0.7 of 1% is where yields would have to rise to get back to that long-term average for an earnings yield spread. So what does that mean? It kind of means that if I can invest in a corporate bond, an investment grade corporate bond, and I can get 4.3% instead of just 3.58, that might be the time when I say, you know what, 4.3% sounds pretty good to me. I'm going to go that way and take less risk and maybe take a little bit more money out of the stock market. So then the real question is, do we think yields are going to rise to that level, especially in the investment grade corporate world? So that's a very interesting question. I think something we have to keep a close eye on. And it also gets back to, wow, it really seems like things are, maybe overvalued. So are we in a period of speculative excess? Do we need to be worried about the markets? Should we be concerned? Do we have to be more cautious? Let's go back to our friends at Goldman Sachs. They just recently published a paper in late March. And what did they say? Well, they published a paper that said, a guide to bubbles and why we are not in one. So at least our friends at Goldman Sachs don't think we're in a bubble. Now, of course, Goldman Sachs has a reason to not want people to think we're in a bubble because they make more money when people are not worried about the markets. But regardless, I think they made some interesting points in this paper. And they kind of talked about some things you usually see in a bubble, which we're not really seeing right now. So one of which is that we haven't really seen the late cycle economic boom that characterizes when bubbles start to form. Now, is the economy growing quickly? Yes, but we haven't really seen that late cycle boom yet. The other thing they cited is that a lot of times during bubbles, you see an emergence of a lot of accounting scandals and some irregularities in bookkeeping. If you hearken back to Enron and situations like that. And we really haven't seen that. Now, we have seen some scandals, but it hasn't really been related to strong established companies with accounting scandals. So I'll talk a little bit more about that. And they also feel like, they're usually bubbles are associated with very low savings rates. And actually the savings rates right now are actually pretty good. So they're basically saying, yes, there's definitely signs of excess, but not to the extremes of when we think a bubble is forming. And certainly the reason we talk about bubbles is that's because when dangerous things happen in the market, a la the tech bubble burst in 2000, when we saw what happened there, and then the financial crisis in 2007. One of the things, though, that people talk a lot about, it might be a sign of a bubble, are SPACs. So what's a SPAC? A SPAC is an acronym for a special purpose acquisition company, or better known as blank check companies. And so, why are these things sometimes considered a form of market excess? Well, the interesting thing about a SPAC is that, how they're formed is basically, they say, hey, investor, why don't you give me your money? And I promise that I will go find a small private or even a large private company, non-public company, and I'm going to buy it and then take it public and make a lot of money in doing so. So why don't you just trust me to do that? So give me your money, and I promise I'll do that in the next year or so. And if I don't do that, then I'll give you your money back. That's really what a SPAC is. Have SPACs been successful in the past? Sure. Are they always going to be successful? I mean, there's a very spotty track record for SPACs. And the economics of SPACs are usually beneficial to the SPAC runner as opposed to the investor. So I do think it's troubling that we've seen a massive amount of money thrown into SPACs both this year and last year. So this chart is actually pretty staggering. You can see that year to date, and this is actually through a couple of weeks ago or end of the first quarter, year to date, we've had $90 billion thrown into SPACs. That actually dwarfed and that's only through the first quarter of this year. That dwarfed the entire year of 2020. And by the way, 2020 dwarfed the entire last 7 years of SPAC issuance. So this to me is a little bit of troubling because it is a sign of excess. Now, that being said, there's a counter argument to say that one of the reasons that SPACs have become so popular is because, as you may know, the financial industry is very regulated. Sometimes I actually feel like if I sneeze, I need to get approval to do that. So SPACs are somewhat of a countermeasure against that regulation, meaning if a company is thinking about going public, well, there's a lot involved with that. There's a lot of paperwork, there's a lot of due diligence, there's a lot of fees and expenses. You have to hire usually an investment bank. SPACs are already public. So SPACs can approach a private company and say, hey, we think you're great. We'd like to just merge with you and take you public, and we're already public, and then you don't have to worry about it. So that kind of bypasses a lot of the regulatory hurdles that private companies have to go through. So that can be appealing. And quite frankly, for a private company, it's very quick. They get paid instantly from the SPAC. So that can be appealing to like a couple of founders of popular private companies. So that's what SPACs are. I do think that we need to keep an eye on that because there have been, even in the last few weeks, there's been some pretty poor performance in some of the recent SPAC money that's been raised. So that's something to take a look at. Another interesting topic these days in the financial markets are, Bitcoin or cryptocurrency, right? So I thought we'd talk about that a little bit. Really, what is cryptocurrency or what is Bitcoin for those of you who...
Hey, hang on, Steve. Don't
Yes.
leave SPACs yet. We did get a question.
Sure.
Are SPACs a new phenomenon?
Good question. The answer to that is no. SPACs are not a new phenomenon. They've actually been around for a long time because, in general, the premise was, if you had someone who was considered a very smart investor, let's say somebody who really knew, some aspect of the technology sector quite well, let's say 10 years ago, someone could say, listen, I know how to identify private companies. I know which ones are going to be successful. Why don't you give me some money? I'll form a SPAC, and I'm going to start buying those companies out with the money that you give me and take them public. And that was kind of appealing, but at a much smaller level. Like, as you can see from the chart, there was only $1 billion in total put into SPACs in the year 2013. That was actually probably the first year it actually ever reached $1 billion. Before that, we were just in the millions. But now, it's incredible that we're at 90 billion thrown into SPACs just in the first quarter of this year. So the concept of a SPAC has been around actually quite some time, at least several decades, but the amount of money that has flown into SPACs is unprecedented today.
Wow. Okay, just two more came in. Sorry. Sorry, my Ring Central just went off. Does that also mean less due diligence than a more standard model? And then the other question is, how are SPACs different from venture capital companies?
Okay, so good question. So on the first one, the short answer to that is yes. In general, a SPAC is a way to take, in other words, if the SPAC is going to merge and take a company public, a private company public, yeah, the SPAC is really on the hook if that company's financials or earnings projections or whatnot really aren't what they should be. So that's definitely, the due diligence process is definitely less for a SPAC. And by the way, that can be appealing for a company that might be all hype and not so much substance. And if a SPAC believes the hype and the investors in the SPAC by definition therefore believe the hype, that can be troublesome. The other question is, well, what's the difference between SPACs and venture capital? So the difference is venture capital stays in the private realm, meaning venture capital doesn't usually operate too much in the public markets. The idea in venture capital is if you see a very small, promising startup, and usually venture capital can get in as early as these startups are barely worth a couple $100,000. The venture capital firm will say, hey, I think you have a lot of potential. Like Airbnb is a good example where venture capital invested early and said, I think you have potential. I'm going to give you guys $1 million. That means I'm going to take a majority ownership in your company. So I'm going to be a 55% owner, let's say. And then I want you guys to grow as fast as you can. So then let's say the company does grow. And then what happens usually is there's other funding rounds where other companies come in, maybe other venture capital firms, maybe private equity firms, and say, hey, you guys are doing great. I want to invest in you too. And they might say, okay, well, now we're worth 5 million. So that venture capital firm that initially invested $1 million is now all of a sudden their valuation is probably over 3 million, right, for what they invested in. So that keeps going and going through various funding rounds until the company decides, hey, maybe it's time to go public. And when that happens and it goes public, all those initial private investors get paid. Some of them may exit before it goes public and make a tidy profit. It all depends on the situation. But so venture capital is really investing in really early stage companies, helping them to grow, and then cashing out either when they get additional funding rounds or actually when they go public. That's kind of the difference. And venture capital firms are also structured to have experts that help the company grow. So let's say a venture capital firm that specializes in three-dimensional printing may have a three-dimensional printing management expert who can actually help a fledgling three-dimensional printing company grow. So that's part of the VC's appeal to a small company that's looking for funding is not only will they get funding from the venture capital firm, they also will get some expertise and advice from that firm to help them grow. SPACs don't usually necessarily have that type of expertise or a bench of expertise to do that.
Okay, one more. So I knew it was a good topic. With so much action in SPACs, is there a structure to rate them to manage risk?
Good question. The short answer to that is no. In many respects, when you invest in a SPAC, you are investing in the supposed intelligence and wisdom of the SPAC creator or creators. That's really the due diligence right there. That's why it's called a blank check. You are basically entrusting them to take your money and invest it in something that's ideally going to make more money. which may or may not play out depending on their success in doing so. So that's really there's really not much diligence on SPACs out there. Now, there are some companies that are trying to put out research reports on SPACs when they reach a certain size, because then they can analyze, well, because a SPAC can have more than one company in its portfolio. So then they can analyze the SPAC based upon its holdings, but that's still very early stage and probably not that reliable yet.
Okay. I think you're good.
All right. How are we doing on time? All right, we're doing pretty well. Cryptocurrencies. I think a lot of people ask, well, first of all, what is a cryptocurrency, and should I own a cryptocurrency? And so, it's hard for us to really opine strongly on that, but I'll try and be careful in regards to walking the fine line between compliance and advice here. But so first of all, cryptocurrencies are based upon a technology called blockchain, right? So the whole concept of blockchain is the incredible efficiency and decentralization that it offers to facilitate transactions. So it's like a permanent record in the Ethernet that allows you to record transactions that will always be known and traceable. So that's why blockchains are very appealing for people who for cryptocurrencies, because essentially it always allows you to track who did I send money to, how much did I send, and when did I send it, and that is very appealing for both cryptocurrency holders and people who want to do transactions with using those shared databases. So I'm not a cryptocurrency or blockchain expert, but one thing to know about Bitcoin is there is no inherent value to Bitcoin, right? Unlike the US dollar, if I give someone a $100 bill, the reason they know that has value is because it's backed by the full faith and credit of our government, right? Because our government can always print more money or raise taxes to make sure that they are able to give value to that currency. And the same goes for any currency, like the euro, same thing. It is backed by the European Union for the same reason, right? So there is inherent value in those currencies based upon the fact that it has the backing of a government, right? And the government has authority to tax, which means they ultimately have authority to make money to back up the money they're printing. That's not the case with Bitcoin. There's no government backing Bitcoin. The only thing backing Bitcoin is the fact that other people think it's worth what it's worth. So it's not even like gold. Some people associate Bitcoin as kind of an alternative asset like gold. Well, gold is an alternative asset, but gold also has inherent value, right? Gold can be used for various manufacturing processes because it's a mineral. Gold can be used for making really nice, attractive jewelry. So gold actually has inherent value, but Bitcoin doesn't really have inherent value. Bitcoin is only worth what other people are willing to pay for it. Now, that being said, the process of mining a Bitcoin or creating a Bitcoin is incredibly computationally complex. It requires a massive amount of computing power. So one of the reasons that semiconductor stocks did really well and have been doing really well is because their chips are used to do these complicated calculations as rapidly as possible to quote unquote mine Bitcoin. So one of the reasons that people think Bitcoin has value is because the way it was created, it's so hard to actually create a Bitcoin that in and of itself makes people think it has value. By the way, there's only 21 million total Bitcoins that will ever be issued. Some people don't know that. Bitcoin actually has a finite amount. So some people think, well, that's why it's also valuable, because there's only going to be so many. And once Bitcoin stop being made, then the supply is going to stop and then the prices will start to rise. Again, that's not necessarily the case. And right now there's approximately 18 million Bitcoins that have been mined, but the mining process gets more and more difficult as time goes on, so that people probably don't expect all Bitcoins to be mined probably until the next 50 years it will take for all the Bitcoins to be mined. So it's a really complicated market. There's a lot going on, but the fact that it is gaining traction, not just with retail investors, but also with corporations and institutions, right? So this kind of shows the history of what's been going on with cryptocurrency since 2018. And really, it didn't really start to take off until early 2017. And now other companies like Tesla, among others, are actually considered using it for people to actually purchase their products, right? PayPal is now launching cryptocurrency services. And again, this is because the underlying technology beneath cryptocurrencies, which is blockchain, is something that is very appealing for the efficiencies and securities and the security of transactions. So Bitcoin is becoming more popular, and therefore, for some people, it is a reasonable thing to consider as an alternative asset, meaning something that's different from the typical stock or bond or even like gold or commodities. So again, complicated topic. We just wanted to touch on it. But the scary thing is that, again, Bitcoin is very, very volatile, and really the price is simply driven by what the next person is willing to pay for it. So if all of a sudden people decide Bitcoin is worthless, the price could drop dramatically in a very short period of time. So I think it really remains to be seen how this is going to play out. But there are reasons to believe that, certainly some of the more relevant cryptocurrencies like Bitcoin, like Ethereum is another one, they might actually have a place in the economy moving forward, and therefore, might be something that's reasonable to have as an alternative asset in portfolios. By the way, Coinbase, you might have heard, Coinbase just went public. Coinbase is a very popular place where people actually can buy Bitcoin. So in other words, if you want to buy Bitcoin, what do? Well, you actually have to find a place to buy it. So you have to go somewhere like a Coinbase where they connect to your bank account, and then you actually have to go in and purchase Bitcoin. And then Coinbase acts as your wallet. They hold it for you, which is good, because there's been situations where people have, bought Bitcoin and stored it on their own computer. And then if their computer melts down, well, then so does their Bitcoin. So people really like the idea of having a virtual wallet to hold their currency, so it's not tied to their own PC, which can also be hacked, by the way. That's another danger. So Coinbase actually is now worth, I think the last check was over 30 or $40 billion. So obviously people think that a cryptocurrency exchange like Coinbase is going to be valuable, because Coinbase takes a small percentage of all those transactions of people buying and selling cryptocurrencies on their platform. And that's a very profitable business to be in, which is why the IPO is pretty popular. Okay, enough on that. What are some of the other things we're watching, and what are some of the other challenges that we might be seeing out there? You may have all heard about GameStop, right? This is speculative trading in a very thinly traded stock that essentially made the company at one point, more valuable than some of the largest automakers in this country, which is really quite insane if you think about it. We also had a couple other things. You might have heard about this one family office called Archegos, which basically lost $20 billion in a matter of days, which also cost some investment banks a lot of money. I'll talk a little bit more about that. And then, you've probably seen headlines about how current valuations might be extended because they might be at risk, because guess what? There might be higher taxes coming down the pike. And not just higher taxes from a personal perspective, but also at a corporate level. And that, of course, can put a damper on company earnings. And as we know, if company earnings don't come in as expected, then maybe the market value is going to be considered to be higher than it should be, and that can hurt stock valuations. So I'll just touch on Archegos real quick. Actually, this guy Bill Huang actually lives in a couple of towns over from me. So I found that whole thing very interesting. So essentially, what was Archegos? Archegos was what's known as a family office. What's a family office? A family office is a lot like a hedge fund, meaning it's something that manages usually a large amount of money, But because it doesn't manage other people's money, hence the term family, it just manages its own money, it's not really regulated that closely. So family offices can usually have relationships with investment banks because they have a lot of money. They want to do a lot of trading. They might want to do specialized options strategies. And they may want to get a lot of leverage. Leverage meaning they may want to borrow a lot from investment banks. And by the way, investment banks are usually happy to extend leverage. Why? Because investment banks make money when they extend leverage to companies. They like, just like a bank, they get interest on the loans they give. So what happened with Archegos is that they were able to basically conceal how much they had in certain stock positions from various banks, which allowed their leverage to get to a point that was so high that when some of the stocks that they were investing in ran into challenges, the banks were not able to unwind that leverage quick enough to avoid losses. So, there's been a lot of press about that. And, oh, doesn't that mean we need to regulate markets more? And I have to say, and this is my opinion, I think the answer is definitely no, because really in the Archegos situation, the only people who really got hurt was Archegos. They're basically bankrupt now, and the investment banks. They were the ones taking the risk. They knew what risks they were taking. And if they didn't know the risks they were taking, well, then shame on them. And that's really it. So yes, we've seen that Credit Suisse First Boston has probably lost a few $1 billion as a result of that blow up. But again, that's really limited to them. There wasn't really any systemic risk going on there. So I actually think that, that's not so much of a big deal. Although I'm sure investment banks are going to tighten up their risk controls to make sure that they aren't going to let anything like that happen again. So I think that was an interesting development that happened in the market. I know I've been talking a mile a minute. Any questions that we've seen come in?
Nothing as of late. Please, anybody, we're open to any questions you have.
Okay, good.
But
About some other things.
wait, we got something.
Okay.
Of a mention of the ramifications of the pending tax increases and market participation and income taxes. Were you going to cover that?
Yes. So we'll talk a little bit about.
Did you get all that? Should I say it again?
Yeah. I think the general question is, what are potential tax increases mean for the markets and potentially my portfolio? So let's talk about that. But before that, I also want to talk about another challenge that's kind of emerging that I think we need to keep in mind so this is an interesting chart, right? This actually shows the top 10% share of pre-tax national income, right? So in other words, what does this mean? It means the top 10% of earners in this country actually earn over 50% of the income, right? So, and as we know, that's creating sort of a very bifurcated economy in terms of sort of the upper class versus everyone else. And so that can be troubling. And why? Well, if you look at the expenditures of the top 10%, this chart shows that the top 10%, the same ones from over here, they actually only spend 64% of their income. Whereas the bottom 90%, in other words, everyone else, they almost spend all of their income, right, on a regular basis. So why is that troubling? Well, the consequence of this is that it actually reduces demand for goods and services. Why? Because that means 36% of all this income is being saved by the top 10%, right? So that dramatic increase in savings is what inflates assets, right? And because that's where that 36% in savings goes. It usually goes into the market. So if we see developments where tax rates go up, especially to a punitive level, then it's likely that this number will then increase. There won't be 36% savings anymore. That will go lower. And if that goes lower, meaning the top 10% can no longer save as much, that can mean that asset prices will not get the support they've been getting, and they potentially can decline. So this is one phenomenon to keep an eye on, and you can see what might happen if tax rates go up, because this savings rate will certainly go down. So before we get into some more of those answers to those questions, we also, when we talk about savings rate, let's talk about interest rates or inflation. So can anyone guess what has been the average rate of inflation over the last 50 years?
Everyone go ahead and vote.
Steve, a few more questions came in too, so when we're done with this polling, I'll read them.
Sure, and one of the reasons, by the way, why do we talk about inflation, or why are we worried about inflation? Well, because inflation has a direct impact on interest rates and bond prices. So that's why inflation is really important, and it's important to make sure we have an idea of what's happening with inflation.
Okay, get a few more in. All right, everyone get your votes in. I'm gonna go ahead and share.
All right, let's see, what do we got?
Okay, here we go.
We have the majority, almost over 2/3 of you saying 3%. Good guess, but no. It has actually been a 4% average over the last 50. So, so let's talk about inflation for a second. We get a lot of questions about that. So first of all, why do we even need inflation? Is inflation a good thing? And really the answer to that is actually yes. And when you hear the Federal Reserve talk and economists speak about inflation in general, 2% inflation is considered probably an ideal type of inflation rate. Why? It's because the economy tends to function better when we have a low, but at least reasonable inflation rate. Why? Because then companies know that if they're making, products, they can anticipate the prices that are being paid for those products to slowly go up. If, for example, we had no inflation, or even worse, deflation, then companies that aren't really incentivized to produce much. Why? Because consumers, therefore, if they think prices are going to go down, well, consumer behavior is going to say, well, then I'm not going to buy anything. I'm going to wait for the price to go down, right? So that can be a vicious cycle in terms of economic production, which is why having a bit of inflation is actually a good thing. Now, do we want it to be 4%? No. And the Fed has been very explicit that they definitely want to see inflation 2% or higher. And they're really not afraid of it going higher. So that's one thing to keep in mind. So let's talk about inflation. So this chart shows, since the early 70s, when we had actually hyperinflation, what the inflation rate has been. And you can see right now, if you look at the 50-year average, again, the headline CPI, which is 4%, the core number actually strips out food and energy. A lot of people refer to the core number because the food and energy numbers can be very volatile. But you can see as of March or in February, we're basically below 2%, around 1.6 as of March 2021 in the core CPI, okay? So a lot of people are worried about inflation because if inflation starts to pick up dramatically, and we have seen it start to rise, that can be a big negative for bond yields and or positive for bond yields, but a negative for bond prices, which makes investing in bonds even more scary, right? So there is a counter argument, though, to whether or not we should be worried about inflation. So this chart is interesting. This chart actually shows that yes, inflation expectations, both here in this country as well as abroad in Asia and Germany, for example, inflation expectations have gone up. But the actual core inflation rate has not matched those expectations and has actually stubbornly remained quite low. And as a matter of fact, there's been an argument that actually inflation is really not a concern because there are a lot of global deflationary phenomenons going on right now that's going to keep things in check. So what do I mean by that? Well, some economists are talking about how the pandemic has actually accelerated deflationary trends. So I use my good old Aunt Helga as an example, right? So my Aunt Helga, she never used to use a computer, and if I sent her a birthday present, she would write out a thank you card by hand and mail it to me, and she would walk to her local pharmacy to pick up her prescriptions. But, once the pandemic hit, that all changed. Now my Aunt doesn't walk to the pharmacy anymore to get her pills. She actually does that all online. And how does she do that? Well, now she knows how to use a computer. She's actually somewhat computer literate. She actually communicates with people more on the computer. She sends thank you notes now by using the computer. So what does that really mean? Well, actually, that means that a big percentage of the global population is now doing things more efficiently and cheaply, which is a deflationary force, right? And that's something that I think people haven't really appreciated yet. Technology companies, because of the pandemic, they've actually increased their presence in the marketplace. Amazon was one company that certainly was benefited immensely from the pandemic because people ordered even more online, right? Again, what does that do long term? That tends to drive the price of goods and services down. So these are deflationary forces that aren't going away anytime soon. As a matter of fact, the pandemic actually also will probably lower the birth rate globally even further. We are seeing declining birth rates globally. The pandemic certainly didn't help that. The pandemic probably also put a lot of people into early retirement. That's another deflationary force. So I think there's a good counter argument from a global perspective to say that maybe we don't have to worry about inflation too much. And quite frankly, maybe that's what the Federal Reserve is thinking too a bit when they talk about how they're not worried about inflation at all. Now, I'm not saying I fully believe all that, but I think there's an argument to be made that perhaps inflation isn't going to be too much of a concern. So Laura, you said you had a question.
Yeah, so I have an inflation question actually here, but we also have a S&P question. So let me do the inflation one here. Given the raise in building materials and other raw materials and supply chain issues, are we seeing a temporary inflation state?
Yeah, and I think the answer is yes. We are seeing inflation pick up. Definitely, there are, like was just said, that's very true. Building materials have skyrocketed in price. As a matter of fact, I think I read that housing starts were the highest they've ever been this year than they have been since 2006. And that was before the mortgage crisis. So housing starts are on a tear. That's driving up the cost of building materials. But again, I think the question here is that more of a temporary phenomenon? And I think the argument here from a global perspective is it could be, meaning that we are seeing a pickup in short-term inflation numbers. The question is that going to continue to accelerate or is it going to moderate and then potentially even decelerate? So that's really something we have to keep an eye on and we just don't know yet. What was the other question? Sorry.
Okay, here's the other one. Without giving us advice, you must know us, what do you think the S&P will be 1 year from now? All right.
Oh, if I could only tell you that would,
Yeah, we wouldn't be here.
Yeah. Well, let's talk a little bit more. So I think the short answer to what's going to happen with markets is it really depends on interest rates. And interest rates, inflation expectations have a lot to do with interest rates. So let's talk about interest rates for a second. This is an interesting chart, right? Because this shows there are two lines here, right? The top line shows the nominal yields, meaning if you invested in a 10-year US government treasury bond, what would be the yield you got for investing in that? The darker gray line shows the real yield. Well, what is the real yield? The real yield is the nominal yield minus inflation, right? So you'll see like, for example, in the 70s and actually this past year, real yields were negative. And what does that mean? It means that the inflation rate was higher than the 10-year treasury rate. So I think it was Warren Buffett who might have said, and I think this is hilarious, that he said, why would I ever invest in a 10-year investment that is guaranteed to lose me money for 10 years, right? And what he meant was, why would I invest in a 10-year treasury bond where I won't even be able to keep up with inflation? In other words, my real rate of return year after year is negative. And that's certainly what we saw last year. The 10-year Treasury bond last year actually dipped well below 1%. So if the 10-year Treasury bond was below 1% and the inflation rate is closer to 2%, you can see right there why you essentially have a negative return. And again, this is why bonds are really not that attractive an investment right now. And that's why stocks have really enjoyed the run-up they've had, because the alternative to stocks, which is usually bonds, isn't that great. Now, are there pockets of bonds where, you know, it's appropriate to have investments? Absolutely. Bonds still play an important role in portfolios depending on your risk tolerance. And, you know, that's probably another detailed conversation. But in general, bond rates are very low and are, quite frankly, are considered to stay low for the foreseeable future. So that's one of the things. Again, it gets back to that earnings yield spread that we were playing around with the numbers before, which is why until we see bonds giving a more attractive return, we're probably still going to see equities outperform, since there's really nowhere else that people can go to get a reasonable return given the risk they're going to take. So I guess the real answer to that question about, well, where is the S&P going to go is, well, it really depends on what happens to interest rates. That's one of the key factors that we all have to take a look at.
All right, and then back on real estate, and you may have covered this, but what is the perspective on real estate investments with houses going over market value now, and how long may that still run?
So real estate is actually considered almost its own asset class, right? Because you know, real estate is the good thing about commercial real estate in particular is that the returns or the interest rate that commercial real estate investments can make can be variable, right? Why? Because a landlord can change his rent. He can adjust it down if he's not getting the capacity he wants, or he can raise it up if the environment warrants it. So the good thing about real estate is that it's a good hedge against inflation because of the ability to change the rates of return that it generates depending on market conditions. And also, obviously, real estate is, you know, depending on how you invest in it, it's a hard asset, right? You know, land has inherent value because it's a scarce resource. So in terms of a perspective on real estate, and depending on the charts you look at, you know, real estate has returned on average over the last, let's say, 50 years, you know, give or take 6 or 7% as an asset class. Now, sometimes that number has been a lot higher than that, and sometimes certainly that number has been a lot lower. Certainly during the financial crisis in 2007, real estate got absolutely decimated because of the speculation going on in the housing and mortgage market. So the question is, you know, do we see that type of speculation now? Is it time to be concerned? Well, you know, one of the reasons that real estate prices are in many markets today, and by the way, real estate is also sort of a regional phenomenon. Not all markets are equal, but we are seeing, you know, certainly excessive real estate speculation in some markets and very high housing prices. Why? Well, because a lot of people have a lot of money in their accounts because the market has done so great, right? Over 85% in the last, you know, year plus, well, allows people to make a bigger down payment and potentially afford a bigger house or upgrade or improve or all those things. So does that tend to drive real estate higher? Absolutely, right? So certainly it's something to keep an eye on, because if we do see more choppy markets or a downdraft in the market, I do think that would put a damper on real estate. Another thing that affects real estate, of course, is mortgage rates, right? Mortgage rates tend to be benchmarked off the 10-year Treasury bond. So what does that mean? Well, if the 10-year Treasury bond right now is yielding about 1.6%, right? Well, banks, when they make a mortgage, they usually need to make a certain margin or spread over the 10-year Treasury, because banks actually hedge their mortgage portfolios by shorting 10-year Treasuries. But not to get into too much detail, but what does that spread mean? It usually means that banks usually want to make 1.5% to 2% over the 10-year Treasury. So if the Treasury right now is at about 1.6, what does that mean? It means the 30-year mortgage rate is probably going to be around 3 to 3.5%. That's pretty attractive historically. And so low mortgage rates can also make real estate overinflated, because if it's really cheap to borrow, to buy, well, that can inflate prices. So again, the short answer to the question about real estate is it also depends on interest rates, right? Because interest rates are going to change the calculus in terms of borrowing costs. And it's also going to change whether or not other assets are more attractive to invest in. So, you know, again, it's hard to tell what's going to happen with real estate, but are there signs of excess? Absolutely. One of the only comforts, though, in regards to housing is that we have been suffering what we consider to be a housing shortage in our economy and markets for a while. So, you know, this is somewhat of a catch-up phenomenon we're seeing now. But again, you know, definitely certain areas have probably gotten ahead of themselves. Okay, so we're pretty much at the end of time here, but I saw a few questions in advance about, you know, how do I know how to protect or safeguard my portfolio? You know, how are all these tax changes going to change things? You know, these are all questions that are hard to answer, and a lot depends on what happens in the markets, as we've been talking about. But I always like to kind of finish off with this point, which is, you know, look, at the end of the day, the most important thing is take into consideration your time horizon, meaning the longer time you have, the more you should be comfortable about investing in the market. And also diversification is critical, right? So one of the most important things you can do to safeguard your investments is it's not timing the market, right? It's time in the market, and it's also being diversified. So what does this chart show you? This chart is I think, great, because what it shows you is what can happen in a 1-year time frame, 5-year rolling, 10-year rolling, and 20-year rolling time frame if you are invested in the following 3 portfolios. And I'm kind of colorblind, but sort of this quasi green bar is if you're just invested in all stocks, being the S&P 500. The blue bar is essentially a blend, 50-50, the blue bar is bonds, no stocks, just all bonds. And the gray bar is a 50-50 blended portfolio of stocks and bonds. In other words, 50% stocks, 50% bonds. So you can see in any 1-year time period, the worst that you could have done in stocks is lost 40%. And the best you could have done is 47%. Now that's a pretty wide range. So in other words, in the short term, anything can happen, right? Any bonds too, right? Bonds can be negative in any given year, but they can also do quite well. And even a blend can be negative in any given year. Now, let's look at a 5-year rolling time period. This is where it gets interesting. A blended portfolio, even if you invested at the worst possible moment. So for example, let's say you invested right before the financial crisis in 2007, right before the market collapsed. The worst you would have done in a 50-50 blended portfolio is earned 1% on average per year. So in other words, you wouldn't have lost money with a blended 50-50 portfolio, even if you invested at the worst possible time. If you go to a 10-year horizon, even if you invested in all stocks at the worst possible time, let's say right before the dot-com bubble burst, you would have on average lost only 1% of your money over that 10-year time period. Now, that's definitely still a bummer you would have lost, but you'll see that on a blended basis, you would have actually made 2% a year. So, and then if you go to even longer, which is, 20 years, you never would have lost money, even if you were in a full stock portfolio, even if you invested at the worst possible moment. So the point here is diversification matters, right? So even for relatively short periods of time, a la 5 years, you would have been okay, even if you invested at the worst possible time. And on a 10-year period, you would have done much better than okay. So the point is, and this is, kind of, again, time in the market, not timing the market, slow and steady wins the race, and diversification is key. And hopefully this chart gives you some comfort that even if I invest at the worst possible moment, as long as my time horizon is long, I should be okay. So with that, that kind of everything I think I wanted to go through. Sorry if I was talking too much. I tend to get very passionate about these topics, and I'm more than happy to talk about it in more detail with anyone else who'd like to, post this seminar. But I'll just be, if we have any extra time, we can certainly open up for any questions that might have popped up at the end.
Sure, please. You know, if you need to go, we understand. We passed the noon mark, but if you have any questions, let us know and we'll send them over to Steve, or we can unmute you if you raise your hand. Just thank everyone for attending. And don't forget to fill out the survey. I'm not seeing anything. Oh, wait, hang on. Oh, wait. Was that last chart return in per year? Wait, what?
Yes. So in other words,
Per year.
so for example, if you invested right before the dot-com bubble in a 50-50 blended portfolio, right, it means that you would have on average earned at worst 1% a year if you invested at the worst possible moment. If you invested at the best possible moment, for example, you know, right after the, you know, after the financial crisis when the market started to recover, you would have made 21% per year on average. So it's a per year number, the worst and the best. So that's kind of what this chart is showing.
Okay. Lots of thank yous. Thank you. Yeah, that's it. Nothing else coming in.
Yep. Thank you for all your attention today. It's a pleasure. Hope it was fun and informative. Sorry if we went a little overtime, but I guess until next time, right, Laura?
Yeah, sure. And can they contact you?
Sure. Absolutely.
His information's on the website. Katie put that link in earlier. Right? Your number, your email, everything's there.
We can also include a little bit of information about Steve on our follow-up email.
Okay.
And we'll send you guys the link to the recording of today's webinar as well.
Perfect.
Great. Thank you, everybody.
All right. Thank you. Have a great weekend.
All right. Thanks, everyone.
Thank you. Thanks, Steve.